So we're back with Outdoor Outfit Company, and this time we're going to look at the direct materials variances. Now let's take a look at some of the specific information about the direct materials in this vignette to begin with. Remember that the standard costs are 3.5 yards of fabric at $6 a yard. We have the actual cost of $261,000. We actually purchased 50,000 yards and we used 45,000 yards. So let's go ahead and move forward a little bit. We looked at the flex budget variances and the sales volume variances before. And what we're going to do now is take just one number, the $9,000 unfavorable direct materials variance. This is the difference between the flex budget variance and the actual results. If you look at the static budget of $210,000, we used $42,000 more of materials because we made 2,000 more suits. And so that is 2,000 suits times 3.5 yards per suit times $6 a yard. That works out to be the unfavorable sales volume variance. It doesn't explain, though, the additional $9,000 that we spent above the flex budget. So that is either that we paid too much money for the fabric, or we used too much fabric. Something happened in there, but we don't know what it is. So we want to go and we want to break that down very much like we did with the selling price variance. In this case, on the far left, we have actual cost times actual quantity. That's the amount of money that we actually spent. $261,000 was given to us in the problem. Now, the actual quantity of fabric that we used is 45,000 yards. Let's not worry about how much we purchased yet. This is how much we used in production. So if I take 261,000 and I divide it by 45,000 yards, we can see that there is an actual cost of $5.80. So this green column on the left is what really happened. This is our actual cost per yard, the actual quantity used in production, and the total amount that was given to us. On the far right, we have our flex budget. This is the standard cost. So our standard cost was $6, and our expected quantity. We made 12,000 suits. We were supposed to use 3.5 yards per suit. So 12,000 times 3.5 gives us 42,000 yards of fabric. That's how much we should have used in making 12,000 suits. If I multiply those two together, I get 252,000, and that's the flex budget amount for direct materials. So you can see that if I just subtract these two amounts right here, I have 9,000, and this is the unfavorable flex budget variance. We can go back and look at that flex budget real fast. $261,000 for actual, $252,000 for flexible, gives us a $9,000 unfavorable variance. We haven't learned anything new yet, but let's go ahead and do the third budget. This third budget doesn't have a name, it's just a third budget. We're going to pick up the actual quantity of 45,000 yards and the standard cost of $6 a yard. Multiply those two values together for $270,000. The left value is the difference between the actual results and the third budget. If you notice up there, we've held the quantity constant. 45,000 yards is the amount of fabric we actually used. We're holding that constant, and we are varying the cost between actual cost and standard cost. That makes this a cost variance. It talks about how much the cost varies. There is a way to do this with a formula as well, and I'm not going to run through most of the formulas, but they can be derived from this table. So in this case, what we would have is actual quantity times the difference between actual cost and standard cost. So there is our formula. And if I take my actual quantity of 45,000 and I multiply that by the difference between $5.80 and $6, I get $9,000 negative, or $9,000 difference. Then what I need to do is I need to look and see whether this is a favorable or an unfavorable variance. Because the actual costs were lower than the third budget, it is a favorable variance. Let's move on to the right side of this equation. If I take the difference between the third budget and the flex budget, I get $18,000. Now notice here we're holding the cost constant at the standard cost, and we're varying the quantity between actual quantity and expected quantity. So what is this variance called? Well, it's a quantity variance. In this case, the third budget was higher than the flex budget, third budget being partly actual and partly budget. So it's kind of a blend. You notice that I've got the color up there as aqua. It's kind of half actual and half budget. And so if it's higher than something that is all budget, then it's an unfavorable quantity variance. Now what this tells us is we saved a bunch of money. We saved $9,000 by getting a lower cost per yard on the fabric, but we used up way too many yards. We were supposed to use 42,000 yards. We really used 45,000 yards. That's a difference of 3,000 yards at $6 a yard gives us our $18,000 quantity variance. So we bought maybe cheap fabric, maybe we got a bargain on it, but it wasn't very good fabric, and so we used too much of it. That's one explanation. So maybe instead of going and praising the purchasing manager and yelling at the production manager, we should be doing the opposite and yelling at the purchasing manager for not buying the quality of fabric that we were looking for, and talking to the production manager about why it took an extra 3,000 yards to make these 12,000 suits. We'll talk more about the implications of the variances when we get to the labor variances as well. But for right now, let's just go back and compare this one more time to that flex budget. Okay, so I've made this kind of big and just used it to underline that one row. We have on the left our actual results, 261,000. On the right, we have our flex budget, 252,000. In the middle, we have the $9,000 unfavorable flex budget variance, and that is the difference between the two outside amounts, or it is the net of the two variances, the cost variance and the quantity variance. Last thing we're going to do in this video is the journal entries for the fabric. So let's go back to the vignette one more time and look at those key amounts. Fabric was purchased 50,000 yards. We used 45,000 yards. We know that the actual cost was $5.80 a yard from our analysis, but the standard cost was $6 a yard, and they should have used 3.5 yards for each jogging suit. Okay, so let's do some journal entries. We purchased 50,000 yards of fabric with an actual cost of $5.80 a yard. We got that from our table, and a standard cost of $6 per yard. So we need to record this. We're going to increase our direct materials inventory with a debit of 50,000 yards times 6. In a standard costing environment, we always do our journal entries throughout the inventory process through cost of goods sold at standard cost. So this is $300,000. But our accounts payable is for 50,000 yards of fabric at $5.80 a yard. That's how much we actually have to pay the vendor. That's $290,000. We are out of balance by $10,000. What we're going to do is journalize that to a direct material cost variance. There will be a variance account for every variance that we have. Now, this journal entry doesn't match our table because we purchased more than we used. It is worth noting that when your variance is a credit, it's like a revenue. It's a favorable variance. We saved money, or we spent less, or we got more revenue. So a credit balance in a variance account is a favorable variance. If it is a debit balance, it's an unfavorable variance. And of course, it makes sense that this is a favorable variance since we spent less per yard than we were supposed to. Let's go on and issue the materials to work in process. We made 12,000 suits with a standard quantity of 3.5 yards each, and we actually used 45,000 yards. What we need to do is increase work in process inventory by 12,000 suits times 3.5 yards per suit times $6 per yard. That's $252,000. Now notice that matches my flex budget. That is the standard cost times the expected quantity for the actual number of units that we made. We need to take the fabric out of the warehouse now. So we're going to reduce direct materials inventory. We're going to reduce it by 45,000 yards because that's how much we actually took out, times our standard cost of 6 because we put it into inventory at a standard cost of 6. So that's 270,000. We are out of balance a little bit. Let me insert a row here. We are out of balance by $18,000. And of course, you should be anticipating this. This is a direct material quantity variance. $18,000. And that matches our table as well. It's a debit, which is an unfavorable variance because we used more fabric than we were supposed to use. How many yards of fabric are left in the ending direct materials inventory, and at what cost? Did you figure out that it is 5,000 yards at $5 a yard? That should make sense to you if we do a little T account and post the acquisition of the fabric at standard cost, and then post how much was transferred into our work in process. Then we have an ending balance of 30,000. And if I take that 30,000 and I divide it by the standard cost, I get 5,000 yards. Okay, so we've looked at direct materials. We've looked at how we're doing journal entries for direct materials. That concludes this video. In the next video, we'll do this one more time with direct labor.